All the central bankers around the world and all the U.S. stock market participants, they care about U.S. interest rate. And today we're going to talk about U.S. interest rate. On July 2nd, Jerome Powell spoke on a panel with other central bankers around the world. He said Federal Reserve has made a lot of progress and the labor market has seen a pretty substantial move towards better balance. So he's talking about right after the pandemic, Fed injected a lot of money into the market by doing quantitative easing, and that caused an imbalance in the labor market. For every unemployed person, there was a lot of job opening, but now it comes more to a balance. It's more towards one unemployed person per 1.2 job opening. That's what he was talking about in regards to being in more balance. But Powell remained cautious towards lowering interest rate. He said he wants to be more confident that the inflation is moving substantially down. So he's not making any promises that there will be a rate cut by end of this summer. On the other hand, the market actually expects a rate cut by the end of this summer, because if you look at the probability from Fed funds rates future, we can see that the market expect the first 25 basis rate cut in September 18th meeting right here, and then the second cut would come in December this year, right? So not really what Powell was saying. And on July 3rd, the meeting minute for the June FOMC was released, right? But this meeting happened on June 11th to 12th. In the meeting minutes, officials are looking for additional information to give them greater confidence before it's appropriate to lower interest rate. So pretty much the same as what Powell was saying. A number of officials also said that the Fed needs to stand ready to respond to unexpected weakness. Right? Get your money printer ready, pretty much saying. And a further drop in demand may push up unemployment rate further than just reducing the job openings. It's saying Federal Reserve's policy, hawkish policy, may overdo it. Right? You may end up pushing instead of making it more balanced, you may push the economy into a recession. So overall, Federal Reserve officials still seems very conservative in terms of rate cuts. What's very interesting is that the former St. Louis Fed James Bullard come out advocating for rate cut, right? So after the pandemic QE, when the inflation first flared up, he is the number one official that came to the media and said he supports raising interest rate quickly, right? Front loading the interest rate. And now he's the first one coming out to say it's time to cut, right? Do not sit on a high interest rate. It's time to cut. And let's hear what he has to say.
You know, the main issue for the Fed is, I think, we were sitting here last year at this time with 200 basis points higher of inflation than we have today. And we haven't found, if you thought the policy rate was right, when inflation, core PCE inflation on a 12-month basis was closer to 5%, then how can you claim that the policy rate is still okay today with 200 basis points left? You're only 60 basis points from the inflation target. So it seems to me like the Fed needs an opportunity here to get going on its easing program, and so we'll see if that happens.
In this chart, we can see Fed funds rate in blue and core PCE in red. So Bullard was saying about a year ago, we had about the same Fed funds rate at around 5%, and we had about the same inflation rate, right? The core PCE was also around 5%. So if that was okay a year ago, then how can the policy rate be okay for today? Because the policy rate didn't change. Right? Look at that. It hasn't changed for almost a year. Right? Because today, if you look at the core PCE, we're at 2.6% year over year, which is only 60% away from the Fed's 2% long-term target. Yeah, but the Fed funds rate are still holding at the highest level in this rate hike cycle. Has this scenario played out before? If we take the same chart, we zoom it out, right? And if we observe the last time that the core PCE was higher than where we are today, which is 2.6, that was back in 2006, right? And the core PCE was the peaked at 2.67%. And what's very, very interesting is if you look at the Fed funds rate back then, it's at the same level as today, right? Back then, it's 5.25%. Okay, and the terminal rate was reached in July of 2006, right? And they held the rate at the highest point, the highest range until July. A year later, July 2007, and they start to cut. Why did they cut? Because the economy encountered the collapse of the subprime mortgage market, which eventually caused the great financial crisis, right? And then until December 2007, that's the official start date of this gray zone. The gray zone is the official time period for the actual recession. So, long story short, right? From the date the terminal rate, from the month the terminal rate was reached until the beginning of the official recession date, it was 1 year and 5 months, right? If we put the same time to today's situation, right? In this cycle, we reached the terminal rate at around August 2003. A year and 5 months later is January of 2025. If it does play out just like the last time, right? We can have a recession somewhere in there. But of course, every time is different. And let's talk about this situation from the unemployment perspective. Speaking of unemployment, we have to look at the Sahm indicator. It's currently at 0.37%. It's an indicator that uses unemployment rate to gauge whether U.S. is in a recession or not, and it works every time in history. Okay, every time when this rate is above 0.5, we're in a gray zone. Okay, so how is it calculated? It's using the unemployment rate 3-month average minus the 12-month low. That's how you come up with this indicator. Like I said, when the number is above 0.5, it's bad, and we're at 0.37, and it's on a uptrend, right? That's the problem, because when you're in 0.5, you are actually already inside of a recession. And what's very interesting, the creator of this indicator, Claudia Sahm, she was interviewed in June, a month ago. She already expressed this similar feeling of James Bullard, right? She said, even though her baseline in June was not recession, but it's a real risk. She doesn't understand why the Fed is pushing that risk. She's not sure what they're waiting for. So pretty much she's implying that Fed should cut rate now, don't wait, right? And she also said the Fed officials are playing with fire, and they should be paying attention to the rate of change in the labor market and potential danger ahead, right? Because her indicator uses the unemployment rate to calculate, right? And she said the worst possible outcome at this point for the Fed is to cause an unnecessary recession. Okay, so that's plenty of warning. So as a conclusion, this is all I want to cover today. What do you think? Should the Fed cut rate sooner to prevent potential economic downturns, or should they be cautious, just like how they are right now, to prevent the inflation to flare back up again? Do you think their action is justified? Let me know in the comment section below. Please don't forget to subscribe to my channel. Thank you very much. Bye.